All right, so we're going to do part 2 of Sharon from Illinois. Remember, she's our single divorcee, 63 years old. She's already retired. She's currently on Social Security and getting a pension, and she's doing fine. And she's no getting around that. She's doing fine. So the question is not if Sharon's going to run out of money, but how do we maximize her net worth to reduce taxes on her and potentially on her kids and or grandkids, because she would like to leave something to her son and daughter and the grandchildren as well. So she's not run out of money, but should she do anything differently to take advantage of the tax code? Now, last episode, if you want to go back and have seen it, I showed you how the tax trap for Social Security comes in, how if you take a $10,000 distribution from an IRA, you're actually going to pay taxes as if you took an $18,500 distribution, because the tax man from Social Security gets taxed as well. So remember, she went up from Social Security being taxed, $2,000 of it being taxed, to $12,000, but having done nothing more than taking a $15,000 IRA distribution. Not good. So let's see if we can do something about that. So let's dive right into this. Don't forget to subscribe down below. And you might like my black cow shirt. That's the mature manure, black cow, mature manure, black cow. So if you ever listen to Dirt Doctor podcast, at least I used to, I haven't listened to it for a little bit, but they used to advertise like crazy on Howard Garrett's Dirt Doctor podcast. All right, so let's change a couple of things here. I'm not going to revisit all the stuff in here. What I'm going to do, though, I'm going to change where we're going to stop Social Security now. So we're going to say, don't do her income today. Let's take her income at 70 instead. All right, so we're going to take her income at 70 instead. All right, so we're not doing Social Security. That means the income's got to come from someplace. And watch what happens when we change that around a little bit. And you'll start to see that there'll be pretty big distributions from her 401k, because money's got to come from someplace. And it's going to come from her pension and her 401k distribution. So here we go. Oh, I forgot to talk about expenses last time too. But anyway, here we got, she has $38,000 of expenses, which include $21,000 living expenses, $3,800 healthcare, and $13,000 for her mortgage and her property taxes and homeowner's insurance. So her total expenses are $38,000, a little bit more than $3,000 a month. But we do factor in healthcare at $3,800 a pop. We do have a mortgage, and we do have property taxes and insurance, and then we have just basic living expenses to put food on the table. So our total expenses are $38,000 a year. Where does that come from? Well, it's going to come from her pension, $16,200. But then you can see we don't start taking Social Security until she's age of 70. So she needs $16,200 is what her pension is going to give her, but she has expenses of $38,000. So we need $22,000 to come out of someplace, and it's going to come out from her IRA. And so here we actually also have taxes a little bit too. So we're going to start pulling money from her 401k/IRA, which is going to increase her tax payments. And this is the net flows. So she needs $22,389, $25,130, so you can see all that. That's coming from her IRA/401k. In fact, if we go over here, we can show you accounts. Is it invested assets? No. Yeah, right here, net cash flows. But let's go to accounts. Withdrawals from accounts, and you'll see it right here. So these are distributed. So first and foremost, they're going into her taxable accounts, then they're taking it from her 401k. And then when she hits 70 and her Social Security and her pension are more than enough, she doesn't have to take it from those accounts anymore. Now, does she? Let's take a look. Will she have planned distributions, either what known as required distributions? The answer is yes. All right. So she's still going to have planned distributions, RMDs. All right, so let's look here now. So from a tax perspective, her taxes stay around $4,000. I didn't calculate all these, but because I can show you something else there, do. So she's still paying, not insignificant taxes. I mean, she's still paying $18,000 when she's 90, $16,000 at 89. So let's just look at what the 1040 or the tax situation looks like. Remember, before she was basically paying nothing, and then it jumped through the roof when she hit RMDs. Now she's paying a little bit more, but it doesn't quite jump through the roof when you hit RMDs. I challenge that state tax thing. I don't think Illinois has a state tax when it comes to where the money's coming from, but we can dive into that a little bit deeper. Anyway, so never does she get above, until she's about 70, 82 years old, does she get above 10% to the feds? Not at all. So let's just look. We're going to go to the state taxes here. She's got $16,000 from a new, let's actually, I want to go to 2022. The reason I want to go to 2022 is because at that point, her cash bucket will be exhausted, and she's got to take it from her IRA / 401k, from her pension, but she doesn't have Social Security at this stage. So now it's $44,319 is her adjusted gross income. We subtract the standard deduction. She got taxable income of $30,000, and her taxes are $3,394. So far, so good. Let's fast forward until we get to 2029. And here we're starting to get Social Security. But look, I mean, at this stage, because her RMDs are not very high, $11,934, her pension hasn't adjusted with inflation. It doesn't. She's only paying tax on, what's that, 18 divided by 44. Basically, 40% of her Social Security is subject to income tax. Remember before, it was getting up there about 85%. And so now when she's at, I forgot how old she is here, but still in her 70s, she has $4,214 in tax. So let's just I just want to look at something real quick. Let's dive into this and see what the tax bracket looks like relative to what she's paying before, when she wasn't doing anything. So here, she's tax payment at 71 is $3,800, and before, tax payment at 71 was right there, $4,800. So she's paying, so you see, in 18,409 in 2025, and here it's 2025 is 18,010. So not a significant difference, actually, just not that much difference because of RMDs. So, but she's still paying less. It's just not as much as I'd like to see. I just want to 83. She's paying 10,000 here, and 83. She's paying how much here? She's paying 12,000, 20% off, but still not as huge as we'd like. So let's try something else. So we stopped taking Social Security, and instead we're having it coming from her accounts right now, from her 401k, to make up the difference. But what happens if we start doing Roth conversions, my friends? Actually, let me see something else. I want to see something else. So how much is an account when she's 70 years old under this model? Let's take a look. So when she's 70 years old, how much does she have in her 401k? At 70, she has $241. All right. Okay. Yeah. So we want to say if she has 241, let's do 15,000. Let's just see 15,000 times 7, 105. Let's see what it looks like. So what we're going to do is we're going to convert 15,000 on top of the amount she's taken out of her for her expenses. All right. So we're going to convert 15,000 a year on top of how much she's taken out from her 401k to pay for her bills until Social Security kicks in. So let's do 15,000 and see what we look like here. All right, so 15,000. We're going to start next year. We're going to increase it each and every year by 3%. Just as an FYI, I have the investment returns of basically 6 to 7%, depending on how the right capital is looking at stocks versus bonds. She does have a pretty significant exposure to Apple, so that's going to be a large cap stock. So that's about 7.5. So we're looking at about 7% rate of return. We have inflation at 3%, Social Security increasing at 2.6, and we have the investments increasing at 7. All right, so that's kind of what we're looking at here. Now she's very heavy into Apple, and I said you might want to step back from that a little bit. She's going to do that. All right, so. What we're doing. Let's take a look at taxes now. So we're doing 15,000 a year into the Roth. So let's take a look what the tax man looks like now, and significantly lower. So here we're bumping up a little bit because we're taking money out from our IRA or 401k to pay our living expenses. 10% to the feds, nothing to the state. And now we're going to these last couple of years at 71, 72, and 73 to 75. We're basically paying about 10% total, and then we fall off a cliff here, and we're just paying about 4%. And let me show you what that means here. I'm going to show you a tax detail, and we're going to go to 2039. Let's just give you, or 38. Let's show you. All right, so here we have 55,000 of Social Security. We have nothing coming from IRA distributions because it's all in the Roth. 16,200 pensions. So between our Roth IRA, our Social Security, and our pension, we have, that's $71,000 right there, just between these two alone, just between Social Security and pension, $71,000. We're only paying tax on 30,000 of that, which means we're only paying $1,100 tax. So let me show you what it looks like, actually, because I already did this. So now we're paying about $1,100 in tax, and if we go down here, This is the taxable amount under the scenario we're just using. All right. So actually, I'm sorry. We want to go right here. So this is the taxable amount under the scenario we're using. Before we did anything, as she's currently situated, she paid roughly $25,000 in taxes over the course of her life. Watch this though. She's only going to pay $120,000. She's going to pay basically less than half, $100,000 less in taxes. And the reason for that is because we're not getting double tax on the Social Security distributions, like I just showed you here. I mean, so because there is no IRA distributions, she's not getting double dipped on the Social Security. I mean, I'll show you what I'm talking about. If we go to 2031, nope, 2000, let's go to 2029. Yeah, here we go. And what you'll see here is she has $44,607 of Social Security benefits, but $26,000 is taxed simply because she has this big IRA distribution. Now, the part of that, the $15,000 of that is going to Roth conversions, and her taxes there are $6,867, as you can see right here. All right, so that's $6,867 in taxes, and the reason is because $26,000 is going to be taxed of her Social Security will be subject to tax. Look at 2030 was 2000. Bear with just a second. 31. There we go. Once those RMDs stop, once those IRA RMDs or any distribution stop, her Social Security, again, it just isn't taxed nearly as much. So here's $46,866 of Social Security income, of which only $9,400 is taxed. We go to the previous year, 2030. Oops, right there. $45,722 of Social Security income, of which half is taxed, even more than half. About half is taxed. And simply because this right here, and that's what I'm trying to say to people, that you're paying double tax. It's just, there's no other way around that. It is absolutely double tax. So you go forward to 2043, again, $63,000 of Social Security income, of which only $17,000 is subject to tax. And the only reason, because there's only one other source of income, which is this right here, $16,200. Everything else is essentially tax-free. And so now I just showed you, you're saving $100,000 of income taxes there alone without question by doing the Roth conversions. It's ridiculous. There's no other way around that. It's ridiculously awesome, if I may. So that's part two. Not worried about running out of money by any stretch of the imagination. She's not. I mean, she can change her investment. I guess we can make it aggressive if we want. I don't know if it's going to do much of a difference. I mean, it's already at 100%. I haven't jived that. I don't know it do that much different because she's already pretty aggressive. It's not going to change much. So I want to go back to analysis. Seems like there's something else I want to share with you. I guess that's pretty much it. So we monthly expenses, that's $1,750 are recurring discretionary expenses because we already have her home mortgage, we already have her property tax, we already have healthcare in there as well, and then you're adding to the taxes as well. I mean, it's just this. So here's the strategy. Here's how this works. You stop Social Security and you come back around and you say, I don't want Social Security now, I want it later. All right. And so what happens is when you see that later at 70 in this case, instead of getting $18,500 a month now, $1,850 a month now, she'll get basically twice that, $40,413 when she hits 70, because she's stopping taking Social Security now. She's saying, don't give it to me now, give it to me later. And now she has to take the money from someplace, and she's going to take it from her 401k. And then if the 401k, if we can get 7% a year, it will drop down. I mean, because she's taking $14,000 or whatever it is, the money she needs to live on, plus the $15,000 a year distributions that she's converting to the Roth, $15,000. And you can see it does drop till she's 70 years old to about $226,000. But then it starts kicking back in, because then we start taking money from the 401k. All it is RMD, because now we're living large. We don't need any distributions from the IRA/401k to live on, because Social Security is covering that plus the pension. I mean, look at it. So now we're adding to taxable accounts because we still have RMDs of in this case $4,273, $8,477. So all that's going into the taxable account, just building and building and building until she has $1.132 million. So $1.132 million with a heck of a lot less tax, whereas before she had, I think it was $1.305 million. Yeah, right here. So now she's got $1.123 million. So about roughly $200,000 less of total account value, but $100,000 less in tax. And by the way, don't forget, a sizable portion of this will be taxable as income to her heirs. This amount right here, this is the older account when we weren't doing any Roth or anything, will be taxable as income to the heirs. And if the heirs are in a 25% tax bracket, state and feds, they're going to lose 25% of that $500,000 minus 25%. They're going to lose, they'll have $375,000. So in this case, they'll lose $125,000. So it's basically breaking even. She'll save $100,000 in taxes, plus she'll give the same amount to her heirs. It's just a winning scenario. And in fact, we can even dive in this deeper to do more Roth conversions if we want on the front end, to even have more to give tax-free to her heirs when she dies. So when she dies, she's going to give right here. All this will go to her heirs, $1.06 million going to her heirs completely tax-free. She has not scrimped and saved. She's done just fine, and she'll give the $71,000 to her heirs at her death too, both of which will be tax-free. That's the story of Sharon. I mean, she's kicking butt, taking names. She should absolutely take advantage of the tax code to start moving money to Roth. There's just no other way around. They're going to save tax. You're not going to have any less money to give. So hope this helps, my friends. We'll be doing a lot more scenarios just like this as we go forward. If you have questions, thoughts, concerns, don't forget to put them down in the show notes. The comments, thumbs up always help. Go to the blog at heritagewealthplanning.com, and we'll see you next time for the next episode we do. And I'm not sure what's going to do. I think we got to do Iowa, the state taxes in Iowa. I overlooked Iowa. So we're going to get to you, my friends, in the Iowa Hawkeye State. We'll get to you. All right. Thanks now. See ya.